The Bucket Plan On Demand series is brought to you by Clarity to Prosperity, a financial training, coaching, and IP development organization led by financial advisors, coaches, and business leaders committed to taking a holistic approach on advising. To learn more about our organization and upcoming training opportunities for financial professionals, visit claritytoprosperity.com.
Welcome to the Bucket Plan On Demand series. So here we're going to do the webinar on identifying risk and investor vulnerability. For the most part, what we're going to really dive into here is the money cycle and sequence of returns risk, because that really is for if you're working in the retiree market, which the bulk of people are working in that space. This is really the biggest risk and vulnerability that they have, which can, is a multiplying effect with longevity risk. I mean, they can run out of money if they have a bad sequence of returns early in retirement. So let's go ahead and start talking about that, Dave.
Yeah, absolutely. I mean, most importantly, this is a big reason that people will hire you for facilitating their retirement planning needs. And so we've seen so many advisors able to use this concept as a purpose or motivation to get that prospect to say, yes, they want to move forward and hire them. So talk about kind of, in the overall planning process, where you start implementing or planting the seeds around sequence of returns risk.
Right. So, and really we talked a bit about this in our podcast series. We won't go into the transition here, but really nice transition that Dave covers in the podcast of going from the fact finder to then launching into explaining the money cycle as a real high level, simple education on sequence of returns risk, because that's what the money cycle does. And so if you look at this 6-step process, this is, so the bucket, the bucket plan is a philosophy first, right? It's an asset positioning philosophy, but there's a process built around it. And we're going to talk specifically around only step 1 today, the money cycle, which is creating the need for wanting to plug into the bucket plan as a philosophy as a whole of segmenting your money to mitigate the risk of sequence of returns risk. And so, but this is kind of just high level visual of the whole process, and we'll cover these in subsequent webinars moving forward.
Yeah, I mean, Jason, you nailed it. And we spent our last webinar and podcast for the Bucket Plan On Demand last month talking about it. But it's sales 101. You have to create the need before you provide the solution. And the money cycle and just educating on sequence of returns risk as a whole really does a phenomenal job at creating the need ultimately for the bucket plan as the solution. So, we spoke about the money cycle earlier, and the money cycle is developed as a way to simplify the concept. Jason, talk a little bit about how you position the money cycle versus really dumping the data, resources on the prospect to explain sequence of returns risk.
Yeah. So first thing I'll do is I'll say, have you ever heard, and listen, I will say this, I always cover the money cycle, regardless if I'm talking about sequence of returns risk or not. Every time I'm always starting with the money cycle, and then I decide if I want to go deeper and explain sequence of returns risk if there's a need for that. But the money cycle is always covered as the first point. So have you ever heard of the money cycle before? I'll ask the prospect. And so I want to initially ask them the question, get them to respond to me to promote engagement. They're going to be dialed in, because people might be looking you right in the eyeballs and you think they're listening to you, but they're thinking about golf, or they're thinking about what they're going to do with their kids or grandkids or who knows what, and they're staring you right in the pupil. And you think they're listening, but they're really not.
How many people on this webinar just zoned out?
Yeah, exactly, right? Quit multitasking. So close those emails. But anyway, so what I do is I always like to ask that question to get the engagement, right? They don't have a choice but to pay attention when you ask them a question. So I want them to pay attention. So first thing, have you ever heard of the money cycle before? And so I get a response, most people know. And okay, well, the money cycle is something we all go through throughout our lifetime. And it has three phases: accumulation, preservation, and distribution. Now, the accumulation phase is something we're going through when we're younger and we're working and we're preparing for retirement. We have a long time horizon before we're going to need to access those funds. And therefore, we can take on more risk and volatility because we're not going to need the funds anytime soon. We can, if we lose money, we're working. We can make that money back. If we have a big market correction, we have time for it to rebound and have that money come back. And so we can afford to take on more of that risk or volatility in the accumulation phase. The second phase is preservation, where we preserve a portion of the assets that we're going to draw from in the third and final phase, distribution. Distribution to ourselves in retirement, distribution to our family upon our passing. Now, the biggest mistake that we see people make is they go directly from accumulation into distribution, and they never preserve a portion of the assets that they're going to draw from throughout that first phase of retirement.
That's great. And so, there's a couple tools that we created at Clarity. Again, you can reach out to one of our business development team members. They could help you get these tools as a deliverable from this webinar today. But that exact script Jason just went through to explain the money cycle is all dictated out. So, you learn by practicing. You learn by going through the script, reading it, memorizing it. And it's such an amazing thing to really set the stage for the rest of the planning concepts you're going to talk about. Because, if we think about it, what the money cycle does is it simplifies the concept of sequence of returns risk, right? How we eliminate sequence of returns risk, bad years early on in retirement, is we establish a preservation phase of the money cycle. And so there's this script that's all written out. We also created a bullet point version of it for those of you who are maybe practicing on how to nail this script, nail this concept with your prospects and clients. Just some of the key bullet points that Jason mentioned in his version of what he just delivered. What are the key bullet points you want to focus on in the accumulation phase? What are the key bullet points in the preservation phase? Things like you have less time to make mistakes or experience major volatility. What key points in the distribution phase? And then most importantly, what's that biggest mistake? Going directly from accumulation into distribution.
Nobody wants to make the biggest mistake. So, that terminology is pretty powerful. And just as a little disclaimer, don't use these scripts in front of the clients, right? Don't read from it. Don't even have the bullet point for one in front of you.
It's not story time at the library.
Yeah, exactly. So,
they're just really handy tools as you get to understand and prepare. Yeah. Now, Jason, what about when clients are like, there's two things that I've seen meeting with prospects here. Sometimes they get the money cycle and you move forward. Other times they don't quite connect with the concept of sequence of returns risk, or maybe they're like, show me more resources or data behind it, right? So that's where you start to bring out some of these other tools.
Yeah, and I'll tell you what, for me, Dave, in that first meeting, I am almost never pulling out these other tools. The reason I'm covering the money cycle, right? But for sure I am, because I also cover the philosophy of bucketing, right? Mm-hmm. But where I tend to pull these tools out is more when I'm at the closing meeting to get them, to have them move their assets over to our firm to manage and put an actual bucket plan in place for them. And I want to really reinforce sequence of returns risk and the danger of it. And we'll show you some of these tools here in the preceding slides.
So one of the things, you'll see that first bullet point, we shared the philosophy, the concept of the money cycle earlier, but here we say the laminated tool. Why do you laminate this tool? You laminate it so that you can use it as a prop in your office, right? And so a lot of times what we'll do is we'll take the Money Cycle laminated tool as a prop, and the front side of it will have what you see on the left-hand side of the screen, the Money Cycle in the 3 phases: accumulation, preservation, and distribution. On the back of it is what you're going to see over on the right-hand side of the screen, which is just accumulation and distribution. And what this does is, if you think about it from the standpoint of somebody being able to comprehend what you're explaining, put yourself in the shoes of if you weren't looking at the webinar right now and you were just verbally listening to me explain the Money Cycle, it might not connect as well as if you were listening and visually looking at it. And so by having the laminated tool front and back, you can open your desk drawer, grab it when you go to explain the Money Cycle, and you could actually show them on the front hand side, accumulation. And what I personally do is I point to each one. I point to the word accumulation, the word preservation, the word distribution as I'm explaining those, and then I flip it over. And as I'm flipping it, I'm saying the biggest mistake that we see people make is they go right from accumulation, and again, I'm pointing to it, into distribution. So it just helps people connect the verbal with the visual and actually understand it in a much more efficient manner.
The other thing on the Money Cycle, before I forget, you can go to youtube.com and just punch in the Money Cycle, and there's a really cool whiteboard video explaining the concept. So if you're not, comfortable enough to deliver the concept, or, it's just powerful, I'll use that whiteboard video from time to time to explain the Money Cycle, because I like to do it in each meeting to keep it front of mind, and so they understand. And so it's nice to have different modalities of how to deliver that information.
Absolutely. So another kind of high level concept is this is a great, if you have a whiteboard in your office, or you have a legal pad that you can draw on in front of the prospect, this concept does a really good job at showing why losses, especially in retirement in that distribution phase, are pretty significant for a retiree. And so here's just a quick example. We say, are you familiar with this concept of the new math? And what the new math says is this formula. When does negative 30 plus 43 equal 0? And so, you just write that across the top of your whiteboard. Negative 30 plus 43 equals 0. And if you want to make it engaging or interactive, you could figure out, or see if your prospect gets it right away. It might help you understand who you're sitting across the desk with. Maybe, somebody who understands this concept or math in general. But what you could do is basically start on the left-hand side of the whiteboard and write $1 million on there, for example. And so the whole concept is, if you have $1 million and the market falls and you lose 30%, how much do you now have? 700,000, right? And so make it interactive or engaging. So we have $1 million. The stock market goes down by 30%. We now have $700,000 in our account. How much do we need to earn to get back to even? How much do we need to earn to get back to even? And you certainly gave them a hint earlier, negative 30 plus 43 equals 0. So 43%. If we lose 30, it takes us 43% just to get back to even. This is why compounding losses are so damaging to any investor, but we're going to also talk in a minute about how a retiree adds on to these damaging losses. So negative 30 plus 43 gets you back to even. What about this next example of a 50% drop? So in the dot-com bubble in the early 2000s, in the S&P, we saw a 50% drop. In 2008, we saw another 50% drop. And so if you had $1 million and you lost 50%, you now have $500,000. Again, interactively drawing this out with your prospect. How much do you need to earn to get back to even? Well, you need to double your money, right? You need 100% return to get back to even. So you can see again how much more you need to earn just to get back to even. Now, I'm going to show simple math here. So let's assume you're taking 5% out for retirement income each year. And so again, I'm not factoring in compounding losses and all of the other things that we know as financial professionals go into this. I'm just trying to use simple numbers for the
It's
client.
50 grand a year, 5% off that initial.
Right.
50, right.
So we lose 50% and we take out 15% over 3 years. So now we're down 65% total for simple math purposes. How much do we need to make back to get back to even?
175%.
175%. And at this point, your retirement is probably shot, right? I mean, if you lose and we see a big downturn in the stock market, 50% while you're drawing income out, look at how much you need to recover by to get back to even. And the reality of it is because you have less of a base to earn these positive returns on. And so this is another really simple whiteboard way to explain the concept of sequence of returns risk. Down markets while you're drawing money out makes it harder and harder and harder to recover into the future.
That's great.
And you used an example of like, I mean, what if it's somebody who doesn't need retirement income, but they're in their 70s and they have qualified money? Does this still impact them?
Yeah, required minimum distributions. It's forced income. Can cause sequence of returns risk.
Right. So maybe it's not 5%. Maybe they're taking 4.5% out for required distributions. You could use this same concept of how that can deplete their ultimately the money they leave behind to their children, their family, their charities, because of the concept of sequence of returns risk eroding their wealth.
Right. Now this chart is really an awesome one. We call this feeling lucky, is what we've named this chart. So what this does is takes us through the series, and we're going to walk you through how we use it to explain it to a prospect, right? So we're going to show to you the difference of during accumulation, meaning you're not taking withdrawals, versus during distribution when you're taking withdrawals, and the effect of sequence of returns risk. So first, we're looking at, in all examples we're going to show you is $100,000 amount and a 6% average rate of return, right? We know there's differences there, but we're showing an average rate of return. No withdrawals. So this is during the accumulation phase, so they're not taking any withdrawals. So what you're going to see here is you're going to see positive returns early on, 2 great years, positive 30, negative or positive 20. The sequence of returns is the negative years later on, so negative 20, negative 30. Now, those basically cancel each other out when you're doing average rate of return. The positives cancel out the negatives. You have 1, 2, 3, 4, 5, 6, 10% returns in between. 6 times 10 is 60. 60 divided by the 10 years is a 6% average rate of return. So at the end of that time, they're going to have $154,764. Now, what happens if we reverse the order of returns? Reverse the sequence to have the bad years early on, the good years later. Does it, same 100,000, same 6% average rate of return, we're not taking withdrawals, doesn't make a difference, right? Sequence of returns risk does not matter in the accumulation phase. There is no difference. But what happens if you're in the distribution phase of the money cycle? Same $100,000, same 6% rate of return, but we're drawing $6,000 a year out of this account. We got the positive years for early on. We got the negative years later on. Same 10s in the middle. $105,000. Not bad, right? You drew out $60,000 over those 10 years, and you still have over $100,000 left. And this is, I remember what I always thought the way it worked. If you average 6%, you could draw out $6,000 a year. This is the way your prospects and clients think, right? They actually think if as long as you average that rate of return, that's what you can draw out. Well, it's true, but it's only half true. It's only if you have a positive sequence of returns or order of returns early on. What happens when we reverse them? $38,000, $38,898. So sequence of returns makes a huge difference when you're taking withdrawals in retirement.
So if you're positioning this with your prospects, I mean, you talk about the money cycle, and the biggest mistake that we see people make is they go right from accumulation to distribution. I mean, this is quantifying that mistake, right? It's showing that if you don't take the time to preserve a portion of the money that you're going to need for income in the first phase of retirement, you could end up over on the right-hand side like Mr. Unhappy if we experience some negative returns in the first few years of your retirement. And what's a great follow-up to this is just asking a simple question: where's the market at right now, right? We're at an all-time high. Is there a higher likelihood, and none of us have a crystal ball, but is there a higher likelihood that we're closer to the end of this bull market than the beginning, right? Could we experience some negative returns early on in your retirement if you're getting ready to retire in the next few years?
And what if you get that engineer that's like challenging, well, those are hypothetical or those aren't real returns?
Yeah, so this is a great piece that actually shows real returns. So the first one that we showed was more conceptual. It's basically how math works, right? But if they're like, well, show me returns of the stock market and what it actually did. Well, what's great about this piece is if you kind of scroll down to the bottom of this page, I always start with the orange and the blue block down at the bottom, where it says average ROR, or average rate of return. And I generally cover up the top half. And I'll sit down and I'll say, imagine I have two investments that you could put your retirement dollars into. The orange investment is going to have an average return of 11.78%. And the blue investment is going to have an average rate of return of 11.2%. Now, this isn't really a trick question, but which one would you rather have your money in? The orange or the blue? And what do you think they say? They say, well, the orange, of course. I'd rather have the higher rate of return. And then I say, well, in retirement, success isn't really predicated on your rate of return as it is on your account balance. And here's what I mean by that. We have two clients, Mr. Johnson and Miss Hamilton, and I uncover the rest of the page. And I say they both had the same amount of money when they started retirement. It was $100,000. And they both invested in the same exact retirement portfolio, 60% stocks, which was the S&P 500, and 40% bonds, which was the Barclays US Aggregate Bond Index. And they both took the same amount of money out of their retirement account every single year through retirement, $8,000 a year to supplement Social Security and pensions. The only difference between the two is the year in which they retired, not the age that they retired, the year in which they retired. Mr. Johnson in the orange retired in 1969, and Miss Hamilton in blue retired in 1979, so a decade apart. Now you can see at age 65, the first year for Mr. Johnson was 1969, and we experienced a minor downturn in the market. That portfolio was down almost 7%. Miss Hamilton retired in 1979 at age 65, and she had a good return in the market her first year, 11.38%. They both took their $8,000 of income out, and you could see their year-end value. Miss Johnson was at $85,000, Miss Hamilton was at $103,000. And from then on out, you can see what the real stock market returns are. And what do you notice about Mr. Johnson's money by the time he reaches 89 years of age? That's right, he's depleted his account. He's completely out of money by age 90. What about Miss Hamilton? How much money does she have by the time she's 90? She started with $100,000 and she has over $800,000. Now, how does that happen when both of these investors invested in the same portfolio, took out the same amount of money, and started with the same amount of money? Well, this massive difference is purely because of the timing of their returns. Mr. Johnson, in his first 6 years, experienced 3 negative years and 3 positive years, while Miss Hamilton retired into a bull market environment where every year was a pretty substantial positive rate of return until the mid-90s. 1994 was her first down year. And so again, do you think the next 10 or 15 years are going to be more like 1979 through 1994, or more like 1969 through 1973? And if you could eliminate this risk from your retirement plan, when would you want to do it?
Yeah, it's awesome. And here's the thing is clients are used to talking about rates of return because that's what most all the investment advisors are out there talking about. And in reality, it's not about rate of return. It's about account balances when you're in the distribution phase, because the game changes. When you're in the accumulation phase, it's all about rate of return. But when you go into the distribution phase, it's about account balance, right? You can't spend rate of return, but can you spend account balance? Absolutely, right? And so you got to reprogram, you got to deprogram and then reprogram your prospects and clients. And what it's also going to do is it's going to get you focusing on the plan versus performance. And so now one of the things we worry about sometimes, or a lot of advisors do, is being commoditized, fee compression, robo-advisors, everything else. But see, when you're focused on the plan and talking about concepts that are not contingent on the rate of return of the portfolio, now you're adding a level of value that's very hard to replace, right, or be commoditized. So it's really important to have these kind of conversations with your client and reprogram them so they're not focused on rate of return, because in reality, it's not even fair if they're in a 60-40 or an 80-20 portfolio with you and they're comparing the rate of return to what the S&P 500 or the Dow's doing. That's not a fair comparison. And you don't want to get caught up in that trap where your clients are comparing your rate of return to their other advisors or what Kramer's doing on TV or whatever other, investment managers out there.
So let's talk about, just to recap, a couple best practices. Number one is this document, the money cycle. Take it, print it, and laminate it. It is so powerful to be able to just pull it out of a desk drawer and walk a client through this concept. Do it with every client on that first meeting. Explain the concept of the money cycle in the 3 phases: accumulation, preservation, and distribution. And the biggest mistake that we see people make is going right from accumulation into distribution. And then another thing would be just pick out one of those concepts of doing a deeper dive into sequence of returns risk and getting really comfortable with it, so that if you need to, you can go from this money cycle conversation, and maybe it's in a subsequent meeting, or as Jason mentioned earlier, when you're going to make recommendations or going for the close, you might need to reinforce with one of those additional tools of sequence of returns risk. And again, using it to create the need, right? Sales 101, you got to create the need before you go and provide the solution. And in our case, we subscribe to the bucket plan as the solution. If you haven't had a chance to go pick up the book Jason wrote on the bucket plan, protecting and growing your assets for a worry-free retirement, you'll be able to actually read how we go from creating the need with the money cycle and sequence of returns risk all the way through designing and implementing a bucket plan for your clients.
And these concepts that we discussed in this webinar too are in that book. So in a really cool format. And it's a great tool to be able to give to your prospects and clients if you are doing bucketing, because it really explains the 3-bucket approach, and it's in a parable format. If you're not familiar with that, it's a true story is what it is, and it walks my clients that I took through the process in a story format. And so what we found is people who are not financial savvy at all love this book because they read it like a story and they follow the characters, and it's a very easy read.
Yep.
And explains these concepts we're talking about on this webinar.
And if any of this was valuable for you, we do a 1.5-day training event called the Holistic Advisor Academy. It's twice a year, every June and December. We've got one upcoming at the end of June 19th and 20th in Cleveland, Ohio. The training fee to come through, you're going to get to go through and listen to 4 offices that each use this process to gather over $40 million on average of new client assets. The training fee is $19.95. That's your total investment to come and attend this meeting. Again, you get to hear advisors in action, how they're using these tools, the point of sales resources, the client material, for a total investment of $19.95. That includes your 2-night hotel stay. So you can go to c2pevents.com for more information, or just pick up the phone, call somebody on our business development team, 888-240-1923. Just have a conversation with them about how this might fit into what you're already doing to enhance your financial advisory business and take your prospects and clients through this type of process. And we also have the white paper available. The white paper on identifying risks and investor vulnerability. You're going to get to see some more of the charts and the resources and how to position this with clients. And if you haven't done so already, don't forget to listen to the monthly Bucket Plan On Demand podcast. Go to your Google or Apple podcast store, search for the Bucket Plan On Demand. Make sure you subscribe to that so you never miss one of those monthly podcasts where we dive into sharing a lot more client stories of how this has been successful for not only Jason and myself, but other advisors and how they position sequence of returns risk.
Well, thank you so much for joining the webinar, and we'll catch you on next month's webinar on this series.
The Bucket Plan On Demand series is brought to you by Clarity to Prosperity, a financial training, coaching, and IP development organization led by financial advisors, coaches, and business leaders committed to taking a holistic approach on advising. To learn more about our organization and upcoming training opportunities for financial professionals, visit claritytoprosperity.com.